Well, hello everyone. My name's Linus Sugis, and this is a re-recording of a session that we did earlier today entitled Lies, Damned Lies, and Life Insurance Illustrations. We're re-recording the presentation because we had some trouble with the way that it worked, and we weren't able to successfully record. So therefore, we're re-recording and posting this on YouTube. Thank you for attending and watching the video. I'm going to be the presenter today. You can read all about me there on the slide. And next month, we had a poll, and the winner in terms of topic for next month is developments with trust-owned annuities, and we will conduct that on Wednesday, October 7th at 11 a.m. Central Time. So we invite you to join for that webinar and all of our free webinars, which occur on the first Wednesday of every month. As I said, today's webinar is Lies, Damned Lies, and Life Insurance Illustrations. It's a bit of a rant, which is a little bit different from our normal presentation. And I guess I apologize for that, although I guess I will give you some practical insights, some practical tips to deal with some of the observations I'm about to make. It's no mystery to life insurance professionals that you sell an intangible product. And in order to effectively sell that product, you have to put together a narrative for your client about how a policy might solve one or more particular problems. And in fact, the good agents that I've worked with over my career do a good job of listening to their clients' objectives, listening to the problems, and matching the story that life insurance tells so that it solves those problems that the client identifies. Now, with any good story, sometimes the story is told more effectively with visual aids. And if you're a life insurance producer, it's not like you have great visual aids to support your story. A life insurance contract isn't much good, except maybe if your client is a lawyer and is interested in reading such contracts. What can an agent come up with? Well, a lot of times the agent comes up with the life insurance illustration. And while an illustration can be an effective tool, they also have their drawbacks and can cause some trouble in certain situations. So if you're an agent and you're proposing selling a life insurance policy, you're normally at some point in the process going to produce a life insurance illustration. What's an illustration? Well, it's typically a 10 to 20 page computer generated document that makes a guess about how a particular policy is going to perform. My background is in universal life, so I'm most familiar with the assumptions that are built into universal life illustrations. But in general, other types of contracts, participating whole life or variable life or equity index products, also have assumptions that are built into them. And an agent will produce life insurance illustrations for those as well, which are guesses about how those products are going to perform over the long term. Now, the thing about permanent life insurance that you can say about the illustration is that because there are assumptions built into the illustration, you might be able to say that the only guarantee about the illustration is that the information on it is incorrect. It's actually going to be wrong. It's inevitable to me that at least one of the assumptions that are inherent in the policy illustration are not going to be met. And if the assumptions aren't met, the projected values are inaccurate. And so that's why I say the policy, the only thing that you can be sure of is that the numbers on the policy won't be the right numbers in the future. So what power does an agent have to be able to use a life insurance illustration effectively? Well, most producers have the ability to at least vary the interest rate assumption inside of their policy. They've also got the ability to make adjustments in terms of the amount and the timing of premium payments. They've got some ability to uh, uh, do to manipulate, to manage the timing of policy distribution, like partial withdrawals, surrenders, and paid up additions, policy loans, all of those things. They may have the ability to influence loan interest rates if loans are taken against the policy. Any change that's made during the course of the policy in terms of interest rate assumptions, in terms of timing of premiums, amounts of premiums, will affect policy performance. And so if you don't 100% accurately predict the future in terms of the things that are variable on the life insurance illustration, you won't have good numbers. In addition to that, producers don't have complete control over the illustration. The carrier has a lot of control over the illustration. The carrier decides how the illustration is going to work, what interest rate assumptions can be used, what cost of insurance charges are charged in the policy, and any adjustments that are made there. Now, the carrier doesn't have completely free rein. They have to comply with the requirements of the state insurance department in order to produce an illustration that is acceptable. And they also have to conform to the illustration model put out by the National Association of Insurance Commissioners. The policy illustration has to conform to that format. And so there's not complete freedom, but the carrier does have some freedom to decide what can and can't be worked on in the policy. So I mentioned the NAIC and their life insurance, model life insurance illustration. You can find a sample life insurance illustration online at the link on the slide. The NAIC says that the purpose of their model life insurance illustration is protect consumers and foster consumer education. And so delivering at least one life insurance illustration as part of the policy purchase process is a requirement. Usually there are two, but one has to be produced as part of the product if it's an illustrated, as part of the process if it's an illustrated product. So the particular sample that we talked about that the NAIC has published is a 15-page sample. And it's a 15-page sample on a prospective 30-year-old insured from a hypothetical company. It's a participating product. And that 15-page sample illustration illustrates 4 different scenarios, which produces 4 different spreadsheets full of numbers. There's a primary scenario based on the current dividend scale. There is an alternate scenario which is based on a dividend scale that is 85% of the company's current hypothetical scale. There's a premium offset scenario where dividends and with potential withdrawals from paid up additions are being used to offset the out-of-pocket premiums. And then there's an alternative premium offset scenario where the 85% dividend scale is being used for the same purpose to eventually make the premiums reduce and go away. And so the client gets presented on that hypothetical situation with 4 spreadsheets. What's the problem with that? Many of you on the call are probably wondering, what's the big deal in this? Well, I think the big deal is this, and I've been in client meetings and I've seen clients' eyes swim with regard to the spreadsheets. If you imagine that you've had no background in the life insurance business and you've got 4 spreadsheets in front of you, and maybe you're good at math, maybe you're not, how do you even begin to sort out what it is that you're looking at? How do you even judge whether the dividend scale inherent in this particular illustration could just as easily have been a universal life illustration, so don't get caught up on that. But how do you even judge whether the dividend scale that is projected for the next 70 years is reasonable? How do you know that your policy is likely to perform the way that you expect? What effect might a change in the dividend scale have on the plan? A change that becomes permanent 5 years from now or 10 years from now or whatever. What's the risk of that happening? How is a client expected to make that judgment? Well, we do expect our clients to make that judgment, and somehow they do make the buying decision, and they need the agent's help. Well, is the agent always able to provide the right help? Well, a lot of times an agent is able to bridge the gap, but in my experience, some agents are not able to fully explain the difference in projected values from one year to the next. While they can talk about interest rate returns, the nuance of cost of insurance charges, or some of the other hidden factors that might be inherent in a dividend paying product, or the expense charges in a variable product, or the nuances of how the index is calculated on an equity index product, they may not be able to do it. And so that's part of the problem. If we expect our lay people, clients, to make informed decisions, informed buying decisions on their life insurance policies, and if the agent can't fully explain them, it feels unreasonable to expect a client to be able to make a reasonable decision about what it is that is involved there. And if it takes an actuary to explain it, it feels likely that most people hearing the actuary explain won't understand what the actuary is explaining. And so it makes performance a little arbitrary, makes the illustration feel a little bit like a prospectus, for example, on a stock offering or a mutual fund offering. So let's talk about some of the issues. Let's talk about the litigation. So in a perfect world, the NAIC believes that the life insurance illustration perfectly explains the product, the permanent product, to the customer. Now, we know that that's probably not true. You know, I guess what I would say is that the illustration does a better job of protecting the agent and the insurance company against liability than it does to actually provide useful information to the client. Maybe you agree, maybe you don't agree, but I think that's at least something to consider. And a lot of the court cases seem to support that idea, where unhappy clients have sued carriers over illustration expectations that they felt were unmet by the actual policy performance. So let's talk first about Brown versus Royal Maccabees Life Insurance Company, which is a case where the policy owner sued the insurance company over a flaw in the illustration system. What was the flaw? Well, the agent gave the prospective policy owner an illustration showing a face amount reduction in the second policy year. The illustration did not show that a partial surrender charge was going to be imposed on the face amount reduction, but the contract did. So the illustration was actually incorrect. The contract was correct. There was a partial surrender charge associated with the reduction in face amount. So the insured, relying on the illustration, sued the insurance company, sued the agent on his own behalf and on behalf of other similar policy owners. And the court dismissed the case, reasoning that the insured should have known that the words in the contract were more important than the numbers on the illustration. Was that reasonable? I don't know, but that's what the court decided, that the insured should have known that the contract actually trumped what the client saw in the spreadsheet. So there you go. There's that case. Let's talk about Cooper versus Berkshire Life. where a married couple bought permanent policies, which they believed, based on the illustrations in part, that the premiums would not be out of pocket after the 10th year. Of course, what happened? Interest rate and expense assumptions changed. The policies required more out-of-pocket premiums for after the 10th year, and the couple sued the insurance company and the agent over their unmet expectations. They alleged they were misled by the agent, and the carrier would be responsible if they were in fact misled by the agent. The appeals court agreed that the lawsuit had merit. It wasn't a final decision on this. The parties probably settled after this decision was made, but the court agreed that the insureds were perhaps misled by the agent, and ultimately probably the insured and the insurance company shared some responsibility for the unmet expectations. Another case, Blumenthal versus New York Life. The policy buyer got ticked off because the agent produced an illustration based on the proposed premium, and the proposed interest rate was only going to last for 17 years. And the policy owner thought that was kind of silly. Why would I buy a policy that was only going to last 17 years based on current assumptions in this premium stream? So the client sued over unmet expectations, and the trial court said, well, you should have known that the illustration lasted only for 17 years. The agent didn't do anything wrong. You should have read the illustration and the contract and figured out that the policy was going to lapse after 17 years based on the premiums that you were going to pay. And so the trial court dismissed the case. The appeals court upheld the determination of the trial court, and in any event barred any further court proceedings because the statute of limitations had expired. So, those are the cases that are out there on life insurance illustrations. And look, if your client has unmet expectations because of an illustration and is upset, that's not a good result in any event. And if it goes to litigation, that's even worse. So what do you do? Well, I think you have to deal with reality. Life insurance policies are relatively transparent. They've got parts that can be identified and lots of things that move. You can decide on the timing of premium payments in a lot of cases. You can, interest rates can change, underlying performance can change. Those choices can be good for a consumer, can allow a consumer to design product, premium stream, cash flow from a policy that can meet the consumer's need. The downside of the flexibility is that the consumer's got to be educated about all the choices that can be made. And it's the agent's job to fill the gap. The agent's got to assess what the client knows, got to figure out what the client needs to know, and bridge the gap between, what the client's reasonable expectations might be and the policy's actual performance. And it's not just at the beginning, but it's along the way as the policy performs. That's part of the service work that's necessary with regard to permanent life insurance policies. So what are best practices for an agent with life insurance illustrations? Well, here are a few suggestions. First of all, I think it's indispensable for an agent to understand what the client's needs are. And I think for most of our clients, we should use life insurance illustrations sparingly, not to hide anything from the client, but to avoid confusing a client with too many spreadsheets, too much information. In addition to that, I think it's up to us to become highly educated on the inner workings of all the policies that we propose, and to have detailed knowledge about the variables that are built into computer generated illustrations and be able to set the client's expectations with a sensible explanation of how those things work. Some clients are more analytical than others. For those clients who are analytical and who are interested in seeing more spreadsheets, well, we can give them to them. But that's probably going to be the exception rather than the rule. And so I think the first thing that we use illustrations sparingly is the right thing. And then the last thing, which is hard to do because our clients need to help us with this, is we need to be prepared to spend the time needed to help a client understand the details of a policy illustration, the assumptions and the guaranteed and non-guaranteed elements. So I'd like to thank you for attending today. Thank you for watching this YouTube video. If you have questions for us regarding today's content, feel welcome to email at asktheexpert@advancedunderwriting.com. In addition to that, if you'd consider subscribing to our YouTube channel, you found this video, you're probably on our YouTube channel. So if you would go ahead and click the subscribe button, that would be great. We'd appreciate it very much. Thank you for watching.